Saurbah Mukherjea, Chief Executive Officer in Institutional Equities with Ambit Capital, joins us. Saurbah, good morning. Thank you for joining us. Let's start with a big smile on your face, because Nifty is doing all the right things. In quick time, Nifty has gone from 5950 to 6300. What is driving stock prices up? Hope, hype, or genuine recovery?
I think it's a mixture of things. I think firstly, FIIs have realized that macro governance in India, both at the central bank level and at the finance ministry level, macro governance has been over the last year to a different standard compared to most other emerging markets. There's a much greater faith in the way the Indian economy is being run now compared to many other emerging markets. The second is the fact, I think as you were alluding to, the second is the fact that it's increasingly clear that the Indian economy is bottoming out. The macro imbalances around inflation, around CAD are gradually coming back into some sort of control. And thirdly, obviously the election, the announcement of the dates, the direction of the opinion polls, all of that is giving cheer to the FIIs.
Saurbah, morning. Do you think slowly and surely it's going to be all about politics from now up until May? And that's going to be the key driving force, whatever the opinion polls indicate?
I think that's bound to be the case. It's difficult to see otherwise. We'll get a whole batch of opinion polls in a week's time. We'll get the parties' manifestos coming through. We'll get the leaders talking about both the main political parties talking about their contrasting economic visions. So it is but natural that at least over the next 3 weeks or so, there'll be intense focus on politics. Then I think it will die down a bit during the polling itself, because of the difficulty of generating meaningful news flow on the part of the media during the polling itself. I think it will die down, and obviously once we are in the middle of May through to early June, Indian politics will be front and center for global investors.
Saurbah, you've been bullish on cyclicals, and my compliments, you've been dead right, because cyclicals across the board from the recent lows have appreciated by about 15 to 20%. Do you think this is as good as it gets for cyclicals? So now that macros are in place, this really could be beginning of a big upturn in cyclicals.
I think there's three facets to market imbalances that we've been highlighting since August, and I think all three have played out. I think there's further to go. The first is small and mid caps. We had highlighted that small and mid caps in August were at record discounts to large caps. That discount has closed a little bit. Small and mid cap volumes have picked up appreciably, and usually this is a very encouraging indicator for the Indian market. Small and mid caps do take off before the large cap market takes off, and that's happened. That I think leads on to the second issue of cyclicals recovery. We've seen a little bit of it. I reckon this will continue. I think the broader market should hold up relatively well. Obviously election results will play a big role, but provided that goes along the lines the opinion polls are predicting, I think cyclicals excluding banks, I think will continue to do well. And the third dimension we highlighted was value stocks over growth stocks, i.e. attractively valued, sensibly run companies, as opposed to highly valued, overvalued, well-run companies. The value stocks have come back into focus over the last 6 months or so. I think that too will continue. In short, you're getting all the signs of a market recovery that you could possibly expect for in a 6-month window.
We heard the finance minister saying that, they're going to be pumping in money in the entire PSU lot. Does it change your views at all? Because you've had very strong views on the PSU banking pack.
So we have had a sell on every single PSU bank for a long time now. Look, it's evident that regardless of which government is running the country, the PSU banking space will have to be recapitalized to the tune of $40-50 billion over the next 3 years or so. The government clearly doesn't have that sort of money. $40-50 billion is around 2.5% of GDP. The government doesn't have that sort of money. So the question is, how will the government actually recapitalize the PSU banks over the next 3-4 years? Because without such a recapitalization, an economic recovery will be hard to sustain, or even to drive an economic recovery will be hard. My fear still remains that minority shareholders will do quite badly out of a recap, and until more clarity emerges on the precise shape of the recap, what are the measures that the government will take to clean up the balance sheets of the PSU banks, to make them fundamentally better run institutions. Until then, I think it remains a very dicey trade. trade to buy these banks. There really are no fundamental bases on which one can go there and say these are well-run companies that I would like to invest in.
Saurabh, when the Gujarat plant case came up with Maruti, you had a pretty bearish call, and you were recommending a sell on Maruti to your clients. Now that the SEBI as well has given a green signal, would you change your stance?
Look, it's clear that Maruti hasn't broken any rules. That never was our concern. So SEBI has given a green signal. I can't see why they should have done anything other than clear it, because I don't think Suzuki or Maruti have broken any rules. The issue which made us turn sellers on Maruti is what Suzuki is in effect doing is taking away the growth potential that Maruti had by itself. If you as SMC, Suzuki Motor Corporation, come and set up directly owned entities in India, that means over the longer period of time, Maruti's growth potential, its export potential, will increasingly accrue to Suzuki Motor Corporation rather than to Maruti shareholders. And that's the point of view which made us turn sellers. Maruti remains a well-run company in terms of its domestic franchise, but Suzuki's actions suggest to us that it, rather than Maruti minorities, stand to benefit in the longer run, and hence the sell call.
But do you think somewhere Maruti could also be a deep contra buy, because the new car launch Celerio has been a hit? They've not lost market share in the passenger car market. And if I look at the ownership pattern, the most important indication of what institutional investors are changed, the FI limit is at an all-time high.
Yeah. So if you look at Maruti over the last 4 or 5 years, you'll see that the firm fundamentally actually has done a reasonable job of producing high quality cars at attractive price points for the Indian market. Its market share has held up. Indeed, its market share has risen over the last year or so. So the quality of the cars or the product or the marketing is never at question. The question is, how will this firm treat minority shareholders? What will it do to its royalty rates? What will it do with its cash? What will Suzuki do with its cash pile? And that's where there are a whole range of worrying signals that the company has given over the last 5 years, that minorities really are not its biggest concern. And if a large MNC with plenty of muscle, plenty of cash, gives repeated signals that minority shareholders are not front and center in its priorities, then I don't think I can advise my clients to buy shares in that company.
Okay.
Saurabh, you've talked about shifting to cyclicals and the fact that you see post-election some recovery coming in the entire space. What in cyclicals do you like?
I think there's sort of 3 facets to the recovery that we will get. The first is we'll get the beginnings of a capex turn. As you know, over the last year, there's hardly been any growth in capex in India. I think that story will change on the other side of the elections. It will be led by the public sector companies, the large public sector companies such as Coal India, NTPC, SAIL, etc., who have received plenty of cabinet committee and investment clearances over the last year or so. Those CCI clearances will, I think, turn into actual project activity on the other side of the elections, and therefore I would look at L&T as a play on this recovery in capex. It's the only large construction company with a balance sheet strong enough to take on big public sector construction projects. The second leg of the recovery is basically recovery in manufacturing. In the core manufacturing sector in our country, activity has been in doldrums given that industrial growth has been barely 1 or 2%. That I think will change. Cummins India, I would say, is a straightforward play on that. It makes gensets, it's well run, good technology, pollution control norms bite in 3 weeks time. That itself should give a further fillip to Cummins demand. And the third leg of the recovery, I would say, is you're looking at companies which have good brands, good distribution, but have fallen upon hard times as specific facets of their business have underperformed. So an example of that would be Bajaj Electricals. The electricals franchise has been in good shape, but the construction arm has bled a lot of red ink over the last couple of years. My reading of the situation is the construction arm's losses are coming under control. As a result, Bajaj Electricals electrical franchise should now come through, and the market, I think, will gradually come to appreciate that over the next year or so.
So, Saurabh, if your call on macro is bullish, if you are of the view that we could be staring at a new investment cycle soon, well, for the investment cycle to start, corporates will have to borrow more, and the only way you can borrow is that you will have to go to banks. So if you're bullish on macro, why are you bearish on banks? Because banks is always a macro call.
Yeah, absolutely. And look, I mean, our FI 15 growth estimate is around 5.1, potentially going up to 5.5, 5.6 if we get a strong government at the center, rather than a ragtag coalition. But even with 5.5% growth, 5.6% growth, I don't expect industrial demand to grow at more than 4-5%. And I think FY15 will be a muted recovery. The reason I think L&T, the three stocks I mentioned, L&T, Cummins and Bajaj will come through is in a muted recovery they have the credentials to do relatively well. I think where the weakness in banks and where the underperformance of banks and the beleaguered state of their balance sheets becomes a very serious issue in FY16. If in FY15 the government can't find a solution to recapitalize the banks, I think FY16 growth in India will struggle to rise above 5.5% as well. And you're absolutely right, if the banks can't be nurtured back into health, and I think that is a big question mark at the moment, if the banks can't be nurtured back into health, it will raise serious questions about how long it will take for India to find a sustainable economic recovery. No amount of stock market boom can finance the debt cycle of the economy. That will have to come from a healthier banking system, which unfortunately it doesn't look to be round the corner.
Saurabh, in your past interviews I was reading, you've talked about, stocks like an Ashoka Buildcon, Sadbhav Engineering, VA Tech Vabag. What's been the rationale behind these names?
So I think in a way it's a corollary of the L&T point. Remember, L&T, as I said, is the only large construction company with a decent balance sheet. In the smaller construction space, in the smaller road builders, for example, you only have Ashoka Buildcon and Sadbhav left with sensible balance sheets, credible management teams, and an ability to deliver projects on time. The rest of the road builders are in different degrees of distress and different degrees of pain, and hence. If a new government were to kick off a road building program, which I think is more likely to be FY16 rather than FY15, if a road building program were kicked off akin to the Golden Quadrilateral a decade ago, Sadbhav and Ashoka Buildcon would be best placed to capitalize on that because they have the balance sheet strength to actually build roads. The rest of the road builders, I simply don't see them actually building roads until they have a couple of QIPs to recapitalize their balance sheets. So the smaller construction space, these three companies, VA Tech, Sadbhav and Ashoka Buildcon, are the only guys with balance sheets strong enough to capitalize on further order flow activity in an economic upturn. Other construction companies, I'm afraid, will need further dilution before they can actually participate in a recovery.
Are you happy to buy cyclicals irrespective of the election outcome, or you are only buying a little bit of cyclicals and bulk of the purchases you plan to do only after the election?
Our Good and Clean portfolio, the Good and Clean portfolio, the iteration that we launched in September of 2013, I think that has 80% of its constituents are cyclicals. But the type of cyclicals we've been putting in our model portfolios are what we call quality at a reasonable price. You're looking for companies which are trading below their 5-year price to books, 5-year PEs, 5-year EV/EBITDAs, but you also want them to be of reasonable quality. And in particular, you don't want them to be QIP candidates in the first 6 months of a recovery. So L&T fits that bill perfectly. You're looking at a reasonably well-run company. It's not ideally run, but it's a reasonably well-run company with a decent balance sheet, well-placed to recover, well-placed to capitalize on a recovery. Another example I can point to, say, a bank like ING Vashya. Not a sort of market-leading bank, but it's at a reasonable valuation, 1.6 times odd, well-run, good balance sheet, and potentially a special situation there if the Dutch shareholder, the Dutch parent, decides to exit. So you're looking for quality at a reasonable price in the context of cyclicals, rather than going for broken balance sheet plays, rather than going for distressed deep value plays.
You said L&T, my friend, at least half a dozen times in 15 minutes. What is that you love about L&T? As
I said, it's a sign of the times where there's so little else to play in that space that it becomes almost the default play, which I guess is one of the other reasons to think about stocks like this. There are very few strong plays left in the recovery. If you look away from names such as HDFC Bank and Kotak Bank because of their punchy valuations, there are very few well managed, liquid, well-capitalized players left in the recovery, which is why I think the few that are there will do quite well in the first 6 months of a post-election recovery.
Some of the clients you interact with are institutional investors, but unfortunately, a lot of our audience is largely retail and HNI, who are not really desperate to buy high quality and they don't have liquidity criterias. So let's say from a mid-cap space, what do you like? Where are you happy to invest right now with the assumption that if things progress, you could make a 50% upside in the next 2 years?
Yeah. I think one theme that is very difficult for institutional investors to play, but I think it's much easier for a retail investor to play, is the agro-tech theme. I think, as all of us know, food inflation has been a real problem in our country over the last 5-6 years. What that is leading to is it's leading to farmers switching from rice and wheat cultivation to cash crops. Fruit, vegetables, lentils, more poultry activity. And that in turn is creating demand for a whole new range of agro-tech companies. So from Bayer Crop Sciences is pesticides and seeds, to Kaveri Seeds is output, to pesticides, India's pesticides, to Rallis. There's a whole range of agrotech plays out there which I think are structurally very well placed to do well, especially if we get some agricultural reform in the coming years. So for example, if the APMC Acts are gradually dismantled state by state, I think there's a real potential for the food producing sector in our country to take off. So I would look very closely at the agrotech sector, because this is a sector of our economy which will do well regardless of who wins the election. It's a sector of our economy where the rising prices of output should help the food producers, and as in turn the producers of seeds, pesticides and fertilizers, I think will have a good 10 years in our country. So it's unfortunately, other than Bayer Crop, which is a $1 billion odd market cap, there isn't a large play there, and even Bayer Crop, the free float is quite low. So institutional investors find it very hard to play, which I think leaves it ideally positioned for the retail investor out there to make some sensible investments in this place.